Hi guys, it's CryptoBIRB. Adrian speaking. Welcome to today's exclusive video report. And today I've got for you a comprehensive video guide analysis for the technical aspects of the Bitcoin USD spot chart, price chart on the Bitstamp exchange. Okay. Well, of course, needless to say, it's very important to remain and stick to one and the same data provider. So Bitstamp be it for this time. Okay, not going to change and jump between the exchanges so that the expectations and the projections forecasts are basically in tune. So let's give it a go with a top-down approach on the weekly perspective, and to have it basically a look, we are hovering right around the 200-week average support, right? Historically, it's provided nothing but a valuable fundamental support driven by the long-term prices. This is a long-term price trend of Bitcoin, okay, smoothed out. 200 weeks basically serves as several years of data, okay, as an anchor. So it's very important to understand and to realize that each and every single point in here on this 200-week average basically stands for 200 weeks of price averaged all together, okay? It's a very valuable insight. And well, the very fresh candle bar, if you will, closed right at the resistance, right at the average. So is that enough to confirm and validate an upwards breakout, some major bear market rally? Well, I would argue it's somewhere in between, somewhere in the middle, right? It's a no man's land, if you will, because it didn't close right through it. It actually stopped right at the resistance. So far, what can be confirmed is that there has been some little 17,500 upwards rally towards closing right at 200-week average, 22,500. So that's what we know for sure, right? And is that enough to confirm and validate a major breakout? In my opinion, not necessarily, because it takes at least one successful weekly or monthly close through the resistance to validate it, right? There are several levels basically to validate a breakout, for breakout traders. It must be close outside a day or a week, outside specific price technical level. Optional, it may stay specific amount of time, as in, couple of days, couple of weeks. There is a fixed percentage threshold with, let's say, 2-3% above certain level to validate it. Certain volatility factor, as in you would want the price action to close, outside the region of, let's say, double the daily volatility or triple the daily volatility, and so on and so forth. So here, I would argue none of these is actually met. None of those is actually met, and we are closing right at the resistance, so it doesn't necessarily bring short-term promising perspectives, and may in fact well represent the current expectations from the markets ahead of this week's FOMC meeting, okay, which brings and imposes a lot of danger. So of course, realizing the larger trend and context in the top-down approach, we are of course outside and on the south side to the major pattern that had developed for a year and a half. Well, and I would argue that the most relevant price action zone is somewhere where the previous swing lows area were, right? So we are talking about 28,000 level that may now serve, after breaking down towards 17,500s, that may now work as a form of a resistance, right? Because we know that based on the polarity change principle, a broken support turns into resistance as people start doubting its previous power, right? After it basically loses its capacity to serve as a support or resistance. So people tend to naturally anchor towards it in the opposite reverse matter now as a resistance. So as we get close to this level eventually, regardless when it happens, at first it would act as a form of a price barrier, right? Building set of ask orders, sell orders, people realizing the profits, okay, which is going to work as a self-fulfilling prophecy and actually cause this kind of resistance effect out there. Okay, knowing of that, again, I would argue that the most relevant price action based resistance area right now is centered around $28,000. It's never a single straight line. It's actually a set of lines, clusters that would serve the purpose. Okay, so far we know that historically speaking, 200-week average or the whereabouts, historically proved good purchasing opportunities. However, it doesn't necessarily mean immediate V-shaped reversal, just like we had with this COVID pandemic kind of change, right? So be ready for some time to basically spend some, back and forth, some uncertainty right around the 200-week, as long as you do not see a clear instance of a close and break above it. Okay, until that happens, I would argue we actually face the risks of some form of a bearish pennant, bearish flag, if you will. However, be mindful about the representativeness bias, because it's easy to fall into a trap that spotting a certain pattern, this bear flag pattern, just because the last time it broke to the downside, it doesn't mean it's going to break to the downside just this time, okay? The representativeness bias would tell you that we would extrapolate from small samples. So we would just take this local small previous sample and assign overly big importance and significance to it, right? So just because it broke down to the downside lastly, it doesn't mean it's going to break down like this time necessarily. However, the self-fulfilling prophecy aspect of it may favor downwards developments of the price action, should we not see a close outside 22,500. And if we take it lower to the daily chart, I would argue that this shows you well the current risks of what I'm basically talking about, right? So still 200-week average, makes its presence relevantly. And here we're looking at this local consolidation pattern followed by a breakout. But this breakout is actually right now giving a chance and a test to form some form of a rounded retest, breakout retest, right? So it doesn't just take a successful breakout. The retest must hold and withhold to some sort of like a selling pressure. If it fails, if it fails, this basically generates more kind of like cascade of liquidations, and as the protective stops would get triggered, okay, crossing through certain level. And if that trigger basically, just comes true and comes real, this generates the cascades of liquidations on a short-term basis, which ahead of the overall hawkish or neutral or bearish, I should say, expectations towards the FOMC meeting, which is a fundamental event trading day factor, we may see some more deepened corrective movement. So this breakout retest, I would argue it's already not perfect technically, right? Because you would love the previous resistance area to withhold the selling pressure, right? So this previous swing high, should definitely see some rebound off the low summer, from the $21,500, $22,000. However, if we do not see such, like I said, cascade of liquidations may trigger, and we may see some worsened or lowered corrective movement to the downside, overextended on the short-term basis from the cascade of liquidations. Okay, so be mindful of that, especially that there is a lot of risks coming from the hawkish resolutions, most likely from the FOMC members this week. Lots of volatility, lots of earnings reporting, so be mindful about that.